I think the market is really struggling with this shift toward slower growth. And I think that's really why we've seen this level of volatility. The numbers have gotten weaker in the U.S. The numbers had gotten weaker earlier in the year in outside the U.S. So clearly, on a global growth basis, things are certainly weakening, and the market's responding to that. Keep in mind, that's a big shift. I mean, back in September, wasn't so long ago, we were worried about, is the economy too hot? And is the Fed going to move too aggressively and cut off this tremendous growth scenario? And now, a couple of months later, we're there saying, oh my God, the economy's getting a bit slow. So I think this shift is definitely what's created this volatility.
All right, so at this point, valuations are still better in this country.
Very reasonable. Yeah.
Okay, but growth is possibly peaking. In Europe, valuations are cheaper, but the outlook over there, I mean, they wish they had our peaking economic growth, right? But their things are improving from a low level with cheaper value. Does that mean you like Europe more now than the U.S.?
I think we're going to see some convergence of growth rates, and the U.S. clearly was leading the charge over the course of 17 and certainly into the first half of 18. And other markets, emerging markets, developed markets outside the U.S. were lagging. That's now going to get closer, and I think the relative valuation differentials are something to watch closely. Now, in the U.S., if you go from 3+ to 2-ish, 2-ish has been an environment where returns for risk assets have been pretty good over the course of the last number of years. So it's not the end of the world, but I think once you need to see confidence that you're getting that soft landing that the Fed is trying to engineer, and I think to get that soft landing, you need an ease of financial conditions from where they are today.
You delve into politics a little, and I was just thinking about things. It's trying to pick the world leader in the strongest position right now. And I'm having trouble. I'm having trouble. Okay, so we got Trump, we got the Mueller probe, we got the House is now. Then I'm thinking, you know, Macron used to be looking pretty good. I'm not sure what to think of that. I'm not sure what to think of Germany and Angela Merkel. I'm not sure what to think of Theresa May now either. I mean,
President Xi seems pretty secure.
Yeah,
he's very secure.
But this is
secure.
This is a tough time to be a world leader in the West.
I think the political strife that's in Europe, that's in the U.S. to a degree, other parts of the world, is one of those factors that creates anxiety and confidence
cancel out each other.
Equities.
Seems like.
I think the European situation will calm a bit. I think it'll reach a deal. I think Brexit, I'd like to think, often politicians do the tough thing at the last possible moment, so I'm expecting that that's going to be resolved in a reasonable way. We'll see. But put aside the politics, you still have the underlying economics to focus on, and again, you're seeing that convergence of growth. Now, one of the things we're looking very closely at is China. China is stimulating very hard. They've reduced rates. They've increased lending. They've cut taxes. There's probably another tax cut on the VAT coming at some point. And I think there's a multiple quarter lag to that. And I think that's one of the reasons why we've remained overweight emerging markets, even though this year that's been a painful allocation for us.
How would you compare the PEG ratios between Europe and the U.S., relative growth? Which one is cheaper from a...
Well, I think the indices are a little bit misleading because of the components of Europe. Europe has a lot less technology, so while there are a couple of multiple points below the U.S. and emerging markets are even a couple of multiple points below that, emerging market indices are dominated by slow-growing commodity exporters, and the U.S. has a much higher technology component. So weighing all those together, if you look at growth sectors in Europe, DM, and or emerging markets, Europe, and the U.S., they're not that far apart in terms of valuations.